bottom out?
Sure. Let me start with that question. So, Mr. Mundra, we have always maintained that distribution is the only differentiating factor, and distribution is where the difference lies between companies in this industry. So people that can grow diamonds, sell rough, grow diamonds, polish themselves, can only go to a certain level in terms of distribution and capturing share from the value chain. As a design-oriented jewelry company, we have that next level closer to the customer, where we are able to effectively capture an even more enhanced part of the value chain of the entire jewelry supply chain of the industry. And as we move into Origem, we will be going direct to customers. So I think things like this is the differentiating factor, and being able to go closer to the customer and create deep distribution ties. That's a huge differentiator that will separate people from ones that can derive margin from this business and ones that cannot. In terms of raw material prices, lab-grown prices, as mentioned by our chairman in the opening remarks, we believe that we know that they have stopped falling. So effectively, at the moment, we are already sitting on a base across all sizes which are usable at Goldiam. So given the retail industry that we service, given who we are targeting within Origem as well, we sort of are looking at diamonds up to 4 carat of size, right? In this size range, we believe the price fall is a discussion of the past. And, we are at a very, very stable base as buyers of this material have seen in the last few months as well.
And how have the prices behaved in the last, let's say, 2 years? I mean, what has been the price? What was the price divergence between natural and lab-grown 2 years back, and what is it right now?
So I can't comment historically. Of course, the prices have fallen from 2 years ago's price to today. Today, to give an example, a 2 carat natural diamond could be anywhere between 12 to 20 lakhs, 12 to 15 lakhs, more or less. And in lab grown, that would be available around 1 lakh rupees.
Right. All right. Thank you. That answers my question. Thank you.
Thank you. The next question is from the line of Bharat Ginani from Money Control Pro. Please go ahead.
Yes, sir. Thank you for the opportunity.
Sorry to interrupt you, sir. May I request you to please use your handset?
Yeah, is it better now? Hello?
Yes, sir.
Yeah. Congratulations and for a great set of numbers, and thanks for providing an opportunity. 2 questions from my side. One, given that you alluded that the customer inquiries from the United States, which is the largest market for you, have been very good, and we have seen very good growth in Q1 of about close to 40%. So what is the revenue guidance, if any, you would like to give for FY25? And given that we have, LGD retail business also starting from Q3, we'll have some stores. So overall, what is the revenue guidance you would give for FY25? That was my first question.
So, Mr. Bharat, I think first quarter we have done remarkably well by closing at 40% higher revenue. I believe that for Q2 and Q3, the visibility is very sound, and hopefully Goldiam will be able to beat its best performance historically for the entire year in terms of revenue as well as profitability. We are looking at growth, and we are looking at growing close to 15 to 20% for the entire year or more.
And sir, my second question is that now LGD is, as you pointed out in Q1, it's close to 70% of our revenue contribution. So I just want to understand that if you are able to provide what is the carat-wise distribution in our revenue for LGD. So is it majorly 1 carat, 2 carat, 3 carat? So if you can provide a revenue breakup for that, for LGD.
We will have to get back to you on that, but more or less, most of the LGDs that we export is 2 carat and below.
Okay, so thanks and all the best.
Thank you.
Thank you, Mr. Bharat.
The next question is from the line of Rajesh Jain from RK Capital. Please go ahead.
Hello. Yeah, good afternoon, sir. I just wanted to understand your business in a bit more detail. I just wanted to start out by understanding what are the factors which are driving the price decrease. I mean, you said that it is a thing of the past and the reports have been coming quite late. That's all right. But what were the factors which drove the prices down sharply on a continuous basis? And what can lead to price increase in future, if at all?
Sure. Thank you, Mr. Rajesh. So, to give a quick summary, since to understand our business, you have to know that we are a design-led jewelry manufacturer and exporter at the moment. All of our designs are created in-house, and we showcase our designs to our customers, to large retailers, organized retailers in the US and other regions, but primarily in the US. And basis on that, we are able to deliver designed, in-house created jewelry, both for their stores as well as their online websites. The prices that have fallen are our raw materials, which is the diamond, lab-grown diamonds particularly, but also natural diamonds. Within the lab-grown diamond space, the reason for the decrease in the price over the last 2 years has been the surge and the growth of supply that has come into the industry from large growers who have set up capacity in regions like Surat and Jaipur, etc. So a lot of this capacity came into the market without a distribution output. Now, at Goldiam, being a distribution-focused, design-oriented jewelry company, we are able to today take advantage of the lower prices by creating and offering a distribution channel for some of these goods that were produced because of the excess supply. So we actually find it in some sense favorable from the long-term standpoint. We have deep relationships with vendors and supply chain in Surat and other markets as such. And yes, I hope that answers the question.
Yeah. So you mentioned about the supplies coming up in Surat and other areas in India. So who are your competitors in the lab-grown manufacturing in India, especially in the listed as well as unlisted space?
So there are no real listed competitors of ours. And again, I'd like to highlight that, please see us as a design-oriented jewelry company. We are a value add on top of lab-grown manufacturers. So lab-grown manufacturers predominantly today are part of the supply chain, and to Goldiam become our raw material suppliers and our vendors rather than competition. We have direct relationships and access to US retail. They become the vendors that we are able to rely on for diamond sourcing, and then create the designs, the jewelry, everything in-house, produce the jewelry and export to US retail.
Okay. So the large US retailers to whom we supply the LGDs, do we have any long-term contracts with them?
Great question. So the way the industry works is that once you have a SKU or a style design set up with a retailer, as long as that style performs well, all reorders of that style get locked to you. So our focus is always on creating designs which can be both new as well as appreciated, long-lasting, and sort of timeless in that sense. Because as they sell, if they sell well, we get all those reorders from US retailers. So there are no long-term contracts as such, but the entire business is built around improving your designs and creating deeper and deeper penetration into your retail customers' channels by providing best-in-class designs that are able to last very, very long.
Okay. So on your B2C...
You, sir. May I request you to rejoin the queue for your follow-up question?
Okay, sure.
Thank you.
Thank you.
Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please restrict your question to 2 per participant. If you have a follow-up question, I would request you to rejoin the queue. The next question is from the line of Kaustubh Bubna from BMSPL Capital. Please go ahead.
Yeah, hi. I was wondering, what is the capex per store for this Goldiam venture? How much would it set up on average? On average, how much would it cost to set up one store?
Sure. Thank you, Mr. Kaustubh. So I'll share some overall numbers with you on an approx basis. Of course, it changes store to store, but approximately what we are budgeting for is about 2.7 to 3.2 CR of store inventory per store. A portion of this will be financed through gold metal financing as well. About 50 lakhs for store deposits. It could be between 40 to 60 lakhs depending on store size, location, etc. for the rental deposit that needs to be paid to the landlord, and about similar amount, 40 to 50 lakhs for store build out and fit out costs. So in total, that is about total capex of 3.7 to 4 CR per store, with a portion of it that will be financed with gold metal financing.
Okay, and could you speak a little? I don't know, it may be too early, but I'm sure you guys have done some numbers. Could you speak about what you all are internally expecting in terms of, obviously it differs, it's not more of a generalized question, it differs from where your store is and geographical area, etc. But could you kind of give some sense on what the revenue potential per store and how many years does it need to break even, etc. Unit economics per store.
So, great question. In terms of what we believe we should achieve, our break-evens on a per store level, given that our gross margins will be on the higher side compared to natural diamond jewelry players, will be somewhere, give or take, in the range of 30 lakhs, maybe slightly under, slightly more. We believe we should target 40 lakhs of monthly sales per store. That, gives us a good indicator whether the customers, appreciating lab-grown diamond jewelry is open to purchasing lab-grown diamond jewelry. And that number over time, I certainly see possibility. Even today, on a very well-performing store, could be 1 CR or north of 1 CR per month per store sales. So there is significant operating leverage available if we can create the right brand, the right distribution. Of course, what I believe is very important, the right design to attract the customer to come spend their income with us.
And obviously, apart from that part of amount which is going to be financed per store, the rest is through internal accruals, right? The use of our cash that's sitting on our balance sheet.
That's correct. That's correct.
So no real debt. Basically, we're using our cash on our balance sheet to expand retail in India.
Absolutely. That's correct.
Okay, great. Thank you.
Thank you.
Thanks.
The next question is from the line of Bhavya Gandhi from Dalal and Broacha Stock Broking. Please go ahead.
Yeah, thanks for the second opportunity. Just wanted to know, we say that the realizations have stopped falling, right? But on a YOY basis, LGD jewelry prices are down by 17% realization. So if you can throw some light, if it has already hit near bottom, then are we still seeing any price correction?
Great question, Bhavya. We're seeing actually, so year on year, of course, there was a price decrease that's, a year ago is a long time. But from today, we will not see price correction. What we are seeing on the demand side in the US with our retailers is that they have, the end customer has wholeheartedly accepted lab grown. Now, even the entry level categories, which were earlier still kept predominantly to natural diamond jewelry. So when I mean entry level, I mean a retail price in the US of $1,000 and under. Even those, they want to start testing some lab grown jewelry. Naturally, given that we are becoming a vendor of choice, they are looking to us to introduce new designing in these entry-level price points in lab-grown jewelry as well.
Okay. And with respect to top customers, if you can share our percentage, in their share of procurement, what would be our percentage be? Say, for example, Signet, are we contributing closer to 1% of the total procurement? How has that been moving over the years or over the quarters?
Sure. So without naming names, our largest, the largest specialty jeweler in the US, they have a revenue of over $6-7 billion. I think we would be somewhere in the range of 1 to 2% of their annual buying. So significant headroom for us to be able to grow. Leveraging that is effectively predominantly the reason that we have been able to grow with such strong top line numbers, despite the industry and this customer in question having a revenue decline as well. Within some of our other largest retailers, a large department store, some large wholesale channels, we would be north of 20 to 25% of their annual purchasing. So it depends customer to customer, but rest assured there is significant headroom available for us to further, increase our penetration in terms of sales per store.
Okay. And is it possible to quantify the number of professionals that we've hired, including the marketing team? Because just wanted to understand the on-ground feel or press for the store openings.
Sure. So at the moment we have head office teammates and executives hired for Origem, the retail brand. We have about 9 to 10 people who have joined us and have been, helping us build the brand. Once, very soon we will be looking to onboard stores, sales people as well as further slightly more increase the strength of the head office.
Okay. And just last thing with respect to forex hedging policy, because the dollar is, rupee is depreciating for now. But what if, rupee strengthens next year? Will we take a hit on our books, or what is the forex hedging policy?
So let me take that. The board, along with me, have done a policy for forex hedging, and we follow this policy for the last 7 years. The policy is a minimum. We also import gold. We import some diamonds, right? And we have a natural hedge from our export. So if we import 1 rupee, we export 1 rupee 25 paisa. So we have a natural hedge. So whatever is the open, which is not hedged, 25% of it needs to be forwarded. So that's been our policy. And with that policy, we've been successful in showing profits in terms of exchange gains over the years. And we actually are very comfortable covering, this policy. And if we believe that rupee will go strong, then we will take advice from proper sources of foreign exchange, and probably increase from 25% to 50%. But currently, with 25% hedge policy, we are doing very well.
Okay, fair enough. Yeah, that's it from mine. Thank you.
Thank you, Bhavya.
Thank you. The next question is from the line of Nisagra from NV Alpha Fund Management LLP. Please go ahead.
Yeah, hello everyone. Congrats on the successful execution of the lab-grown diamond business. I had 2 questions. I think earlier we had mentioned that when the lab-grown diamond business will become larger, we will do higher margins. Now, traditionally, we used to do 25 to 20% EBITDA margins. This quarter, obviously, large chunk is lab-grown diamonds. So why are the EBITDA margins at 20%? I don't know if you answered this question earlier.
Sure. So I'll start that and then I'll let our chairman add some comments as well. So thank you for the question, Mr. Nisarg. From our perspective as management, we are realigning and believing that, keeping intact a broader margin guidance, which we had given, that we are going to stick to of that 18 to 22% bandwidth. As keeping this intact over the long term, we want to now realign our focus towards top line growth. This quarter is the first example of that, where we have shown significant top line growth, keeping intact broadly our broad margin guidance. So internally now as management and as we speak to our customers, our priority is on focusing on creating value through not just keeping our margins intact or more or less keeping them, growing them slightly, but furthering the overall absolute number by focusing on top line growth. With that, there might be a little bit of margin sort of salient quarter to quarter, but we believe that's okay given the long-term trajectory of the company. I'll let our chairman, Mr. Rashesh Bhansali, also add on any comments if needed.
Hello, Mr. Nisarg. So besides what Mr. Anmol has pointed out, I would like to point out also that another reason besides us being aggressive in revenue and going forward, that aggression is expected to continue from our side. We also must point out that the high cost of gold, right, is another issue, small issue where, just to get aggressive and get more SKUs accepted by the retailers, we had to do what we needed to do so that going forward, the margins can remain stable. And that is really the reason why you see that. But even on a consolidated basis, 20.1% margin is pretty good, and it's higher than anyone closest comparable in our industry by leaps and bounds.
Absolutely. Sir, two questions. One is that after growing 40% also, traditionally in business which is working capital intensive, there is not a single year where you've not made free cash flow. Like even in this quarter, so it's a compliment, but if you could explain us how is it possible that we make such high free cash flow where so many jewelry players are always struggling to make cash flow and are sitting on debt and high inventory?
Sure. Let me answer that with three reasons. Number one, .com. .com is now 30% of our business, right? And because of .com, we work with a negative working capital. I'm sure when we had met you earlier, you were informed and you're well aware of our .com business, Mr. Nisarg. So 30% of our business works on negative working capital. Second thing, we've been very good with designs and analysis of what part of jewelry is selling in which retail stores in America, right? And because of the team that Mr. Anmol, our MD, has set up, right, we are able to actually give to the customer a better targeted price point and a targeted retail look, right, which helps our jewelry sell faster, right? So that's another very strong feeling. And the shift and such a dramatic and a strong shift from mined to lab grown and in such a short period of time has also helped our free cash flow get better. So I think these are the three main reasons why we have the ability in an industry where there are a lot of issues, as you well know, that Goldiam is probably the only shining star out there in terms of profitability, being still debt-free, growing the business and consistently rewarding stakeholders and consistently giving you free cash flow.
Great. A last question, sir, for Anmol. In the domestic retail business, we have traditionally seen everybody mess up with very high inventory and then the inventory is not sold for various reasons. The fact that we are venturing only into lab grown, does it mean that the economics of our inventory holding will be slightly different from traditional jewelry players? Will it be just in time? Will the customer see the design and order and then you will manufacture it? Could you explain some details on this?
Absolutely. Thank you, Mr. Nisarg. So, yes, short answer is yes. The way to look at our inventory, the economics of it are very different. Inherently, because of lab grown, there are two changes. Number one, if the sort of designs we have planned and the looks, the sizes of diamonds were to be done in natural diamonds, and this sort of inventory was to be held by a single store, the inventory holding value would be potentially 7 to 10 times the value we are looking to actually expend. Number two, because of, again, being within the lab-grown diamond jewelry space and our internal targets to achieve a higher gross margin than our modern-day omni-channel jewelry competitors, even the cycle and turn of inventory will have a larger than otherwise impact on our inventory carrying costs and our reorder capability of inventory. And number three, even, similar to, I wouldn't say this is too much of a difference, but similar to omni-channel retailers, these modern day omni-channel retailers, we will build a very, very robust website from day one with full custom capability itself. So this will also allow ideally end customers to be able to visualize and create jewelry that they like, customize it to their particular sizes without us having to hold size-wise inventory or KT color-wise inventory. So there are certainly nuances because of being in lab-grown that allow us to take benefit as a retailer as we enter B2C, and we are going to try our best to utilize that to our advantage.
Thank you, and all the very best to everyone. Thank you.
Thank you,
Thank you,
Mr.
Mr.
Nishant.
Thank you. The next question is from the line of Ajinkya, who is an individual investor. Please go ahead.
Hello everyone. Congratulations for stellar performance. Am I audible?
Thank you, Mr. Ajinkya.
Yes, thank you, Mr. Ajinkya.
I have very few questions. It may be one-liners, but maybe it may help to understand. Any tentative date for the opening in Mumbai? Is it pre-Diwali or post-Diwali?
We're targeting the first couple of stores pre-Diwali, so towards in the month of October, but plus minus a few days here and there.
All right. Now the other question is, so as I understand, is it wedding rings only that we are planning to do, or is it any customized jewelry kind of?
So the category
like
mix
a bracelet or a, like
yes. The category mix is very, very similar to omni-channel mass retailers today. We will be doing rings, earrings, pendants, necklaces, bracelets, and bangles. The full category.
And any endorsements which are planned? Anything
We're
planned?
working on it with our marketing team, Mr. Ajinkya, so no comments in particular right now on that. Perhaps in the Q2 call, we may be able to share more color.
Thank you. Ladies and gentlemen, we will take that as the last question. I would now like to hand the conference over to the management for closing comments.
Yes, thank you, everyone. We look forward to your patronage, and we look forward to doing very well in the coming course of time as well. And have a good day and be safe.
Thank you very much.
On behalf of Monarch Networth Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.